Whenever I look at a heavily financed business, I start with one question: who has to produce the cash? Not who owns the building on paper, not which company issued the bond, and not where the liability appears in an annual report. I want to know whose customers, rent payments, or guarantees ultimately keep the debt alive. If we apply that tested AI data center boom, the picture becomes much more complicated than the balance sheet suggests. The biggest technology companies used to be famous for turning relatively modest physical assets into extraordinary cash flow. AI changes that equation. Training and serving large models requires land, power contracts, substations, cooling, equipment, fiber, specialized buildings, and huge fleets of accelerators. Before a single customer buys a token of computing, someone has already committed billions of dollars to infrastructure. Even companies with enormous operating cash flow do not necessarily want to fund every campus themselves. The Bank for International Settlements reported that major U.S. hyperscalers issued more than $100 billion of bonds in 2025. Traditional bonds solve the funding problem, but they also make the borrowing impossible to miss. More debt can affect credit spreads, ratings, and the price of the next bond. It can also force shareholders to confront an uncomfortable shift. A business they valued like a high-margin software platform is beginning to finance assets like a utility or an industrial company. This is why I think the most important development is not simply that AI companies are borrowing more, it is that the borrowing is being reorganized. Here is the simplified version. A new legal entity is created to own or develop a data center. It might be a joint venture or a special purpose vehicle. Outside investors contribute most of the equity, and the new entity borrows additional money from private lenders or bond investors. The technology company takes a minority stake and signs agreements to lease the campus or buy its computing capacity. The project company now has the debt. The technology company has the lease, the purchase commitment, or sometimes a guarantee. Under accounting rules, those are not automatically the same thing. If the technology company does not control the vehicle's full debt may not be consolidated into its financial statements. That can be a perfectly legitimate result. But when I follow the cash, I may still find that the lenders depend on payments coming from one dominant tenant. The BIS calls these arrangements shadow borrowing because they can create obligations that behave economically like debt while most of the formal debt remains outside the hyperscaler's balance sheet. I would not call the debt secret. Important terms are often disclosed. The better description is separated. Ownership sits in one place, borrowing in another, and the cash responsibility is distributed through contracts. Meta's Hyperion campus in Louisiana shows how this works in practice. According to Meta's SEC filing, funds managed by Blue Owl own 80% of the joint venture, while Meta owns 20%. The parties describe expected development costs of roughly $27 billion. Meta entered into operating leases scheduled to begin in 2029. The initial 4-year lease commitment is about $12.3 billion, and renewal options can extend the total lease period to 20 years. If I stop there, I might conclude that Meta has kept its commitment short while outside capital accepts the long-term construction risk. But there is another contract that changes the economic picture. Meta also provided a residual value guarantee covering the first 16 years of operations. The threshold begins at about $28 billion and declines over time. If specified conditions are met after a lease is not renewed or is terminated and the campus is worth less than the agreed threshold, Meta may owe a capped payment based on that shortfall. That does not turn every dollar of project debt into ordinary Meta corporate debt. Legal priority, control, collateral, and accounting classifications still matter. But it does tell me that the project's value is not supported only by concrete, cooling towers, and power connections. Part of the financial support comes from Meta's future behavior and credit strength. The balance sheet answers the accounting question. The lease and guarantee help answer the cash flow question. Now add GPUs because the financing chain does not end with real estate. Accelerators are increasingly treated as assets that can support loans. Public filings from AI cloud businesses describe facilities secured by GPU servers and related infrastructure. In one CoreWeave filing, available borrowing was linked to the depreciated purchase price of the equipment and the credit rating of the customer attached to the relevant contract. That is a major transformation. A GPU is not only a tool for running models, it is collateral with an expected resale value and an income stream. A lender can estimate how many billable hours the machine will generate, apply a utilization assumption, project rental prices, and lend against the result. The weakness is that technological life and financial life can diverge very quickly. A power connection may be scarce for decades. A well-located data center building can be refitted, but a particular accelerator can lose economic value. When a newer generation produces more output with less electricity, the chip may continue working exactly as designed while becoming much less competitive. If a financing model assumes strong utilization and healthy rental rates for too long, the collateral can deteriorate before the loan does. This is where people reach for the subprime comparison. I understand why. We have special purpose entities, collateral-backed lending, institutional investors, optimistic valuation assumptions, and risks that are divided among multiple. Balance sheets. Complexity can make a weak link difficult to identify until the market is already under stress. But I do not think the evidence supports calling this a replay of 2008. The mortgage crisis involved leverage across millions of households and losses concentrated inside a banking system that was central to everyday credit creation. AI. Infrastructure is currently more concentrated among large corporations, private funds, insurers, and institutional investors. Some tenants had exceptionally strong cash flows. A campus leased to a highly rated global platform is also a different credit proposition from a GPU fleet owned by a young cloud provider with one major customer. The differences reduce the probability of the same kind of crisis. They do not eliminate the possibility of painful losses or contagion. The Financial Stability Board estimates that private credit has grown to roughly $1.5 to $2 trillion and says connections among private funds, banks, insurers, and private equity firms are deepening. Banks extend credit lines to funds. Insurers and pension capital buy private assets. The same ecosystem can appear as owner, lender, sell, manager, and investor across related transactions. If demand for AI computing disappoints, the first visible problem may not be a hyperscaler default. It could be a smaller cloud provider unable to refinance, a private fund facing redemption pressure, or a project vehicle forced to activate a guarantee. Stress could move from equipment values to loan marks, then from funds to the institutions financing or owning them. The path matters as much as the size of the first loss. So I am not trying to predict a dramatic collapse. I am watching a short list of ordinary signals. Actual computing revenue, utilization, customer concentration, lease obligations, guarantee exposure, refinancing costs, and secondary market prices for older GPUs. Above all, I want to compare the cash generated by an asset with the cash promised to its financiers. That is where every layer of legal engineering eventually ends. A joint venture can change who reports the debt. A lease can replace an upfront purchase with years of payments. A guarantee can make a bond safer for investors. None of those tools can create profitable demand for computing. If AI usage keeps expanding fast enough, this financing architecture may be remembered as an efficient way to build essential infrastructure without forcing one company to carry every risk. If growth slows, the same architecture may reveal that risk was dispersed more effectively than it was understood. Either way, the useful question is not whether the debt vanished. It is whether the cash flow required to repay it will arrive on time. From the customer everyone is counting on.